Last weekend across Australia, 1,257 properties went under hammer. Fewer than half of them sold, 48.9%. That's the combined clearance rate. Same week last year was 67.1%. Now, most people hear that number and think one word: danger, stay out. Sit on your hands, wait for it to settle down. I want to offer you a completely different read on it, because that number isn't a warning sign. That number is a price. It is precisely what it costs a seller when nobody else turns up. And right now in this market, that discount is sitting there in plain sight in the public data, waiting for anyone willing to be the person who turns up. Hi, I am Anita Kumar, the co-founder of A&P Buyers Agency, and today I want to talk honestly about the market everyone's gone quiet on, including the parts of it that are genuinely bad. And then I want to show you the window that I think most investors are about to slip straight through. Welcome back to the show. For anyone new here, my business partner Pratiksha and I run A&P Buyers Agency. We both came out of IT, fell hard for the property and the data beneath it, and now we spend our days helping clients build sustainable wealth through strategic property investment, residential, commercial, off-market. We are in this market every single day. And I will be straight with you about why I am recording this particular episode. Over the last few months, the phone has gone quiet. Not just ours, I am hearing the same from agents, from the brokers, from other buyer agents across the country. Enquiries are down. People who were actively looking in March have gone silent. So I could pretend that nothing is happening, or could talk about it properly. I would rather talk about it properly. Quick disclaimer before we go any further: this is a general information, not a personal financial or investment advice. Everything I'm about to say is in general in nature, and every single person's situation is different. Your goals, your borrowing capacity, your risk appetite, your timeline. I would want to understand all of that before pointing you at any specific deal or price. Okay, I'm not going to stand here and tell you everything is fine. It isn't. Here is the real picture as we record this in August 2026. Nationally, dwelling values are up 5.3% over the past year. Sounds decent, but look at the shorter window. Over the last quarter, national values are down to 1.9%. Those two numbers point in the opposite direction, and when that happened, the recent one is the one telling the truth. The annual figure is the history, the quarterly figure is now. Break it down by city and it gets sharper. Sydney is down 5.3% from its peak in January this year. Melbourne is down 5.5% from its peak and down to 2.8% over the year. Now, here is the part I think most commentary is going wrong. For the last 2 years, the story everybody told was two-speed market. Sydney and Melbourne struggling while Brisbane, Perth, Adelaide ran hot. And that was true. It isn't anymore. Brisbane is down 0.7% from its May peak. Perth is down 0.4% from its May peak. Adelaide has entered modest downturn. All three of them rolled over in the same quarter. So this isn't a Sydney and a Melbourne problem. This is a broad correction, and I think you deserve to hear that plainly rather than have it dressed up. There is one genuine outlier, and it's not one. People expect. Darwin up 16.3% over the year, sitting at the brand record high with a gross rental yield of 6.2%. We'll come back to that in future episode because it deserves its own conversation. And the backdrop to all is the RBI catch rate is at 4.35%, held there after 3 consecutive rises earlier this year. Most economists now expect the first cut around the middle of 2027. That's not next month, it's long way. So that's the honest position. Prices falling in most capitals, rates high and staying high for a while. Buyers gone quiet. And now I want to make an argument that might sound strange after everything I have just said, because the market is falling and you shouldn't buy, are two completely different sentences and almost nobody separates them. Now, why buyers went quiet? Before I make that argument, I want to give a hesitation. It's due because the people who have stepped back haven't done it for a stupid reason. There are 4 reasons, and every one of them is legitimate. Number one, the borrowing capacity has genuinely squeezed, and the real constraint, and it's the underrated. Cancer ran the number on this year's hike. The February and the March increases together cut roughly 25,000 of what single average income earner can borrow, and around 49,000 for a dual income couple. That's not sentiment, that's the arithmetic. People aren't sitting out because they have lost their nerve. For a lot of them, the bank has simply moved their goalpost now. Number two, the headlines. Every week there is another story about falls, and every one of them is technically accurate. When the news tells you an asset is getting cheaper, the human instinct is to wait for it to get still more cheaper. Number three, no relief in sight. The first rate cut is expected in mid-2027. There is no obvious catalyst on the horizon. It's easy to think what exactly I am rushing for. Number four, and this is a big one. Nobody wants to catch a falling knife. Nobody wants to be a person who bought in August and watched it drop again in November. That fear is real, and I'm not going to talk anyone out of feeling it. So those are the 4 reasons. I accept them all, and I still think the conclusion most people have drawn from them is wrong, because every one of those reasons describes the market and none of them describes the deal in front of you. Let me show you what I mean. Now let's see what Quiet actually worth. This is the heart of today's episode, so slow down with me here. When buyers disappear, 4 things happen, and every one of them transfers power from seller to you. These are measurable. I'm not asking you to take my word for any of it. Number 1, vendors start discounting, and we can measure exactly how much. The median vendor discount nationally right now is 3.8%. That's a gap between the property was originally advertised at and what it actually sold for. So say for an example, for 800k purchase, that's roughly around $30,400, and that is the median. That's the typical outcome, not the exceptional one. That's before you have negotiated a single thing well. Number 2 is you get time back. Median days on the market nationally is now 35 days. In 2021, you had a weekend. You had 1 open home, no building inspection, and a decision by Saturday afternoon. Today, you have 5 weeks to inspect the property, get the building and pest report, review the contract, and think clearly. I cannot overstate what that's worth. Almost every genuinely bad property purchase I have ever seen was made by someone rushing. Number 3, and this is one almost nobody is talking about, so listen carefully. Total listing on the market are up 14.9% year on year. More stock, fine, you would expect that in the softer market. But the new listing, brand new properties coming to the market are running 7.1% below the 5-year average. Sit with that for a second. There is much more stock available, but fewer new properties are being listed. Which means stock sitting out there is old stock. It's aged, unsold inventory. It's full of vendors who listed in April, say, who have had one offer or fall over, who have already dropped their price once and told themselves that was the last time. That is the most negotiable seller in the Australia right now, and the market is currently overflowing with them. Number 4 is your competition has left the field. Investor lending is down 3% and total home lending is down 3.8% from its December peak. The investors you were bidding against last year aren't in the room, and notice who hasn't left. First home buyers are 29.2% of the owner-occupier lending, which is actually above the decade average of 27.6%. So people buying homes to live are still going. People buying investment have gone quiet. If you are an investor, read that twice. Your competition has thinned out precisely in your lane. And now put those 4 together. A measurable discount, time to do proper due diligence, a market full of exhausted vendors, and a competitors who have walked away. And here is the sentence I want you to take away from today. The discount you are being offered right now is not a discount on the property, it's a discount in the absence of other buyers, and that absence has expiry date. What happens when the RBI cuts the interest rates? So let's talk about the expiry date, because this is where I think the collective strategy of wait for the rate cut quietly falls apart. Here is a mechanism and it's not complicated. Rate cuts just don't make your repayment cheaper. They restore borrowing capacity, and critically, they restore it to everyone at the same moment. Remember those cancelled numbers? 25,000 of the single borrower capacity and 49,000 of a couple? Cuts hand that back to you, yes, and simultaneously to every other person bidding on the same property. And the property prices aren't set by the average buyers, they are set by the most capable buyers in the room. So when everybody's capacities goes up together, prices go up. That's not a theory, that's how an auction works. But here is the part that really matters, and it is the reason I wanted to record this episode now rather than in 6 months. The market doesn't wait for the cut, it moves on the anticipation of the cut. A&P Shane Oliver documented exactly this in the last cycle. Prices hooked back up, reflecting the anticipation and then the reality of the RBI starting to cut. The anticipation came first, sentiment turned before the rate did. Think about what that means practically. If the first cut is expected around mid-2027, the market doesn't start competing in mid-2027. It starts competing when the commentary shifts, when the front page says cuts are coming. That could be months earlier, and on the day that happens, the 3.8% discount starts closing and 35 days starts shrinking, and the exhausted vendors with the age listing suddenly has 3 offers instead of none. Nobody rings a bell. There is no announcement. The window doesn't close on the day of the cut. It closes when everybody figures out the red rate is coming. And Domain's own forecast for the next financial year has Brisbane, Adelaide, Perth returning to the record highs and gains of 3 to 9%, while Sydney and Melbourne fall further 3 to 8%. So the recovery is expected. It's just not evenly distributed. Which market you are in matters enormously, and that's the whole episode of its own. So what does waiting actually cost? Let's put the real numbers in it. 2 investors, same budget, same target market. Let's use Brisbane and use 800k for an example. Investor A buys now. She negotiates a median discount. Nothing heroic, just a typical outcome, 3.8%. She pays about 769k. Straight away she gets 30,400. She's ahead of the asking price. Then she rents it out. Brisbane's gross yield is around 3.44% and roughly 26,000 of the rent over the next 12 months. And remember, rents are growing at 5.9% nationally, well ahead of the wages, which is 3.3%. Investor B waits 12 months for clarity on the rate cut. Perfectly reasonable sounding decision. Now, even in the flattest possible scenario where the property is worth exactly the same in 12 months as it is of today, investor B has to make up the discount that no longer is on the table when she collected no rent at all. And she collected no rent at all. That's roughly $56,000 of a difference, with the property doing absolutely nothing. And if the Domain forecast is even roughly right and the Brisbane runs back towards the record high, that gap doesn't stay at $56,000, it comfortably doubles. Now I want to be genuinely honest with you here, because I would rather be useful than persuasive. Those are forecasts. Forecasts are wrong most of the times. If the market falls another 5% from here, investor B has done better, and I'm not going to pretend it otherwise. But notice something about that $56,000 figure. It doesn't depend on the forecast at all. The discount and the rent are real today. The growth is speculative part. Most people have a risk exactly backwards. They treat the certain things as speculative and speculative things as certain, when waiting is actually the right call. And because I don't ever want to be a person who says now is always a great time to buy, here is when I would genuinely tell you to wait. I say this to prospective clients regularly. Wait if your deposit isn't there yet. Buying badly funded is worse than buying late every time. Wait if your income isn't stable right now. Serviceability under the stress is not maths problem, it's a life problem. Wait if you're looking at Sydney or Melbourne specifically and you don't have a compelling asset specific reason. Those markets are forecast to fall another 3 to 8%. There is no price for being early into the falling market. And wait if you haven't done the research. A discount on the wrong asset in the wrong suburb is not a bargain. It's just a cheaper mistake. If none of those 4 applies to you though, then what exactly are you waiting for? Because the market feels scary? Isn't a strategy, it's just a feeling. So what should you do in next 90 days? So let me leave you with something practical. I'm not going to tell you to go and buy a property this month. Here is what I would actually do in the next 90 days. First, get the finance sorted before you shop, not after. Capacity is binding constraint in this market. You need to know your real number today from the broker, not a guess. Number 2, pick the market and start learning it now, not a short list of the 8 cities, 1 or 2 properly understood. You want to know a suburb well enough that when the right property appears, you recognize instead of researching for the 3 weeks while somebody else buys it. Third, go and look back at the aged listing. Sort by day on the market. Longest first. That's where the 14.9% is hiding. Those are the conversation worth having. And the whole point of doing these 3 things now, you want to be positioned before the shift, not shopping after it. Because the buyers who do well out of the next 18 months won't be the ones. And the whole point of doing those 3 things now, you want to be positioned before the shift, not shopping after it, because the buyers who do well out of the next 18 months won't be the ones who time the bottom perfectly. Nobody does that. They were the ones who were ready when everybody else were still getting organized. To bring it home, the market is soft and I'm not sugarcoating that. But soft markets hand buyers 4 things they don't get in the strong ones: a measurable discount, time to think, exhausted vendors, and the thinner competition. Every one of those is temporary and none of them will still be there on the other side of the rate cut. If this episode got your wheels turning, if you have been sitting on the fence and you have just realized the fence isn't actually free, I would love to talk. Book a strategy session with A&P Buyers Agency. We'll go through your borrowing position, your goals, and whether this market is genuinely the moment or genuinely a not. I am equally happy to tell you either. And if you got something out of today, do me a favor, follow the show and send this to one person you know who has been waiting to see what happens. They might want to see those numbers. I'm Anita Kumar and this has been A&P. Invest with clarity, act with confidence, and I'll see you in next episode. Take care.